Brent crude has crossed $120 a barrel, while the Indian rupee hits record lows against the US dollar. These pressures have converged to create one of the most volatile trading environments in years. On Wall Street, the Finance Ministry is tracking this as the W.O.R.R framework: war, oil, rupee, and rains. It's a simultaneous assault on India's macroeconomic stability. Within 3 weeks, investors lost 20 lakh crore rupees in wealth. This chart tracks that decline, showing how oil spikes, a monsoon deficit, and a tech shift hit simultaneously. Because the Nifty 50 is concentrated in energy importers, this standard index fund strategy loses its buffer. We are seeing a capital rotation. Market participants are pulling money out of energy-sensitive stocks and moving it into areas that realize higher revenues during commodity spikes and regional instability. To navigate this, you have to move beyond broad market assumptions. You need to know which specific sectors are actually capturing this fleeing capital. Every $1 increase in crude adds $1 billion to India's import bill. This matrix splits the energy sector. Downstream companies like IOCL and BPCL are squeezed. They pay market rates, but retail prices are politically constrained, freezing their margins. Aviation turbine fuel is the largest expense for airlines. For Indigo and SpiceJet, this rally pushes fuel costs to 40% of total operations. Contrast that with upstream producers. For ONGC and Oil India, higher global prices mean greater realization for every barrel extracted. For ONGC specifically, a $1 rise in crude adds over 6,000 crore rupees to its annual earnings. Integrated players like Reliance Industries use their scale to offset volatility. Their upstream gas assets and globally competitive refining allow them to capture high crack spreads, even when petrochemical margins are tight. Here is the trade-off. Holding marketing companies is a bet on government relief and tax adjustments. Rotating to upstream producers offers a natural hedge against oil spikes, but requires an exit strategy once geopolitical tensions ease. Geopolitical disruptions have driven up freight rates and costs for crude derivatives like carbon black. Companies like Asian Paints and Seat derive 25% of costs from these. Their pricing power lags these spikes, causing immediate margin compression. However, the same shipping delays that hurt manufacturers are driving freight and charter rates higher. Companies like SCI and Great Eastern Shipping are seeing increased demand as trade routes are reorganized. Heightened regional conflict is also focusing domestic policy on defense preparedness. As the government prioritizes local manufacturing and electronic warfare, domestic companies like HAL and Bharat Electronics see a direct impact on their long-term order books. The trade-off is one of timing. Buying the dip in blue-chip paints requires enduring short-term margin pain for a potential long-term rebound. Buying shipping or defense yields more immediate results, but leaves you exposed to sudden changes in the geopolitical climate. There is currently a 35% probability of rainfall falling below 90% of the long-period average due to El Nino. This hurts agrochemicals like UPL, as pest infestations decrease during droughts, fueling concerns about a wider rural consumption slowdown. Conversely, extreme heat drives record demand for cooling, causing utility and appliance sales at NTPC and Voltas to spike. This pie chart shows why rural demand is more resilient today. Cultivation now accounts for just 1/3 of rural household income. The rest spreads across non-farm wages, government jobs, and livestock, providing a structural buffer against a bad harvest. The trade-off here is a matter of conviction. Panic-selling rural-dependent stocks often ignores the fact that 2/3 of rural income is now insulated from the weather. You have to decide if the current market correction in staples is an overreaction. Enterprises are currently shifting their budgets away from legacy software maintenance to fund the integration of generative AI. This pressures legacy IT giants like Infosys and Wipro, who face flat revenue as automation makes maintenance more efficient. Conversely, mid-tier integrators like Persistent Systems and Tata Elxsi command higher margins, specializing in high-value AI design where new spending concentrates. Moving away from large-cap IT is a trade. You leave behind the safety of a massive balance sheet for the growth required to keep pace with this rapid change in technology. All of these macro shocks lead to a single decision tree. Your next move depends entirely on your primary investment goal. For the long-term SIP investor, the path leads toward the currently pressured blue chips. Stocks like Asian Paints and Hindustan Unilever are trading at levels that reflect the current crisis, not their long-term earnings potential. The trade-off is psychological. You are buying during a period of intense macro uncertainty in exchange for higher compounded returns when energy costs and rainfall eventually normalize. The alternate path is for the active sector rotator. This leads away from cost-sensitive businesses and into the current beneficiaries, companies like ONGC, HAL, and specialized AI integrators. For the active rotator, the previous market assumptions no longer apply. Success depends on capturing the momentum of these resilient sectors, while the commodity and tech shocks are still active. Global pressures, from the Strait of Hormuz to AI integration, create vastly different outcomes for different companies. A loss in one sector is often a direct gain for another. The Indian market is currently characterized by a sharp divergence in performance. You can no longer treat the benchmark indices as a single unit. You have to evaluate your timeline and choose a side.